Picture this. It's a crisp Thursday evening in the financial capital of the world. Billions of dollars are quietly moving through the markets. Totally normal, right? But then, a whisper starts to spread. A rumor of a deal so astronomically massive, it would fundamentally rewrite the global economy. We're talking about a move that would literally put a staggering percentage of the world's packaged food under one single dominant roof. But then, almost as quickly as the whisper started, the entire thing implodes. Welcome to This Explainer. Today, we are unpacking a high-stakes, absolutely wild financial mystery about a mega deal that vanished into thin air over a single, frantic weekend, leaving Wall Street completely stunned.
$143 billion. Let that sink in for a second. That's not just a big number. That is literally larger than the gross domestic product of entire countries. Imagine the second largest corporate acquisition in history, backed by absolute titans of the financial world, completely imploding in just 48 hours. How in the world does a deal with this much financial firepower, orchestrated by literally some of the smartest people in the room, just completely derail because of a leaked secret and a rushed phone call? Well, to truly grasp the sheer magnitude of this financial earthquake, we have to rewind. We need to look at the players involved long before anyone even knew they were on a collision course. See, these two companies inhabited completely different universes. On one side, you have Kraft Heinz. They're this aggressive, financially engineered powerhouse backed by the legendary Warren Buffett and a ruthless private equity firm called 3G Capital. Their whole portfolio is heavily weighted toward the Americas. And on the other side, Unilever, an Anglo-Dutch institution. This is a sprawling, globally balanced giant with 168,000 employees all over the world. At this point in our story, these two massive entities are operating completely independently. They're entirely clueless about the massive boardroom drama that's about to unfold. They're just completely different beasts, operating with entirely different rulebooks.
To put this into perspective, this massive financial story is sitting right in your kitchen and your bathroom right now. Kraft Heinz owns Philadelphia cream cheese, Weight Watchers, and yeah, obviously Heinz ketchup. Unilever brings Dove soap, Ben & Jerry's ice cream, Marmite, and Hellmann's mayonnaise to the table. Combining these two would have created an absolute behemoth, controlling 3% of the entire global packaged food market. Now, 3% might sound kind of small, but in the highly fragmented world of consumer goods, that is unprecedented market dominance. It's basically a license to print money.
So, what was the financial engine driving this sudden, aggressive urge to conquer? It all comes down to a concept called zero-based budgeting. Let me break this down. In a normal company, you look at last year's budget, maybe add a little bit for inflation, and you move forward, right? Not with 3G Capital. Zero-based budgeting means every single year, the budget goes completely back to zero. Every single manager must mathematically justify every single penny they want to spend. It is famous for ruthless, absolutely brutal cost cutting. It creates immense short-term profits, for sure, but it also requires the company to constantly find new targets to buy up and trim down.
If you want to truly understand the psychology of the buyer here, you just have to listen to Beto Sikupira, the co-founder of 3G Capital. He famously declared, "Costs are like fingernails, they always need to be cut." I mean, wow, that perfectly captures the aggressive, debt-fueled culture of Kraft's backers. These guys are financial hunters. They are constantly prowling for their next massive payday. When they acquire a company, they go in with a scalpel. They trim the fat, fire management, and maximize shareholder value at breakneck speed. That's their DNA. It's exactly how they generate such incredible wealth for their investors.
But this is exactly where we hit a massive ideological conflict. Because over at Unilever, the philosophy couldn't have been more different. Led by CEO Paul Polman, they actually prided themselves in being a kinder, gentler corporation. They had a really deep commitment to corporate social responsibility, environmental sustainability, and long-term premium brand building. They were totally willing to sacrifice a little bit of short-term profit margin if it meant building a sustainable brand that would last for the next 50 years. So you have a total clash of cultures here. The ultimate cost cutters looking at a company that fundamentally believes in spending money to do good.
Which brings us to the absolutely crucial question. Why make a move on a UK-based giant at this exact moment? Why now? Well, the catalyst for this sudden, highly secretive move was actually a massive geopolitical event, the aftermath of the Brexit vote. When the UK voted to leave the European Union, the British pound completely tanked in the currency markets. Suddenly, to an American company holding billions of US dollars, UK-based businesses looked like items in a bargain bin. The exchange rate made Unilever a prime, incredibly cheap target for an American buyer. The math just suddenly made way too much sense to ignore. The trap was officially set. But here is where the thriller aspect of our story really kicks into high gear. Our timeline of the collapse starts on a Thursday, February 16th, with some highly suspicious activity in the financial markets. Suddenly, totally out of nowhere, options trading, which are basically massive financial bets on whether a stock will go up or down, goes completely parabolic. We're talking Kraft put options trading at 7.1 times their normal average, Kraft calls at 5.4 times the average, Unilever calls surging to 4.6 times their average. In the financial world, this is the equivalent of giant, glowing footprints in the snow. It signaled that someone, somewhere, had leaked the secret of the impending mega deal. The Wall Street sharks smelled blood in the water, and they started placing massive bets.
And because of that leak, the entire master plan just completely unraveled. Let's walk through this frantic 48 hours. Thursday, the massive option search happens. By Friday, the secret is completely out. It leaks to the Financial Times. Now, because of incredibly strict UK takeover regulations, Kraft is legally forced to reveal their hand. They have to publicly declare their intentions way before they were ready. By Sunday night, the deal is dead. Kraft amicably withdraws. And by Monday morning, the market reacts violently, with Unilever shares dropping 8%. It was an incredibly fast, totally disastrous weekend. But why did Kraft withdraw so quickly when they had so much money on the line? Let's dig into the numbers. You see, the financial offer they made actually looked incredibly generous on paper. Kraft offered an enterprise value to EBITDA multiple of over 15x. In plain English, they were offering to pay 15 times the cash Unilever generates in a single year. For a household goods company of this size, that is massive. In fact, over the previous 5 years, basically no deals in this sector over $1 billion had closed above a 10x multiple, with very few, rare exceptions. Kraft was offering an 18.5% one-day premium on Unilever's stock. They were bringing a massive, massive pile of money to the table, hoping to just completely overwhelm Unilever's board with sheer financial force.
But as always, the devil is in the details. And this is where the mystery of the rejection really starts to clear up. Kraft's offer was partly in shares, but mostly in cash, specifically about £70 billion in cash. But here's the catch. That cash portion was going to be heavily funded by corporate debt. Kraft was going to borrow a staggering amount of money to buy Unilever. And for Unilever, this was a massive red flag. This heavily leveraged model threatened to completely tank Unilever's stellar credit rating. It would have burdened the combined new company with massive debt repayment costs for literally decades to come.
And remember that incredibly rushed timeline? Because the leak forced Kraft to go public early on a Friday, they literally hadn't had the time to quietly sit down and woo Unilever's shareholders. And Unilever's shareholder base was incredibly unique. 70% of them were long-term investors who had held their shares for more than 7 years. These guys weren't day traders looking for a quick 18% pop. No, these were fiercely loyal institutional investors who loved Unilever's stable, long-term, sustainable dividend model. So when they saw a debt-laden buyout offer from a company famous for slashing budgets, they immediately balked. No way. Sensing this hesitation, Unilever's CEO Paul Polman didn't just casually decline the offer, he went straight on the offensive. He aggressively warned Kraft that there was absolutely no appetite for this deal at the boardroom level, and that his loyal investors would fight it tooth and nail. It was a stunning rejection that completely caught Kraft's legendary investors off guard. As one insider told The Guardian, Kraft Heinz was forced to wave the white flag. Think about that. Warren Buffett and Jorge Lamont, two men who are definitely not accustomed to tasting defeat in a major bid battle, were forced into a historic, humiliating retreat before the fight even really began.
But we can't ignore the massive political pressure adding to this powder keg either. The UK government was already looming over this deal, and Prime Minister Theresa May was known to be highly skeptical of foreign takeovers. Why? Because years earlier, back in 2010, Kraft had controversially taken over the beloved UK brand Cadbury, and they pretty quickly reneged on promises to keep local factories open. With 9,000 UK jobs at stake in this Unilever deal, the government was primed and ready to intervene, demanding legally binding job protections. This political headache, combined with a hostile board, it completely spooked Kraft. So what exactly did Kraft walk away from? By waving that white flag, they lost an absolutely incredible strategic prize. Unilever's global revenue was perfectly balanced, roughly 30% in the Americas, 30% in Europe, and 30% in Asia and the Pacific. Kraft Heinz, on the other hand, generated over 70% of its revenue just in the Americas alone. Acquiring Unilever wouldn't have just made them bigger, it would have instantly transformed them into a truly balanced global empire, giving them an immediate, massive foothold in emerging markets across Asia and Africa.
That was the huge dream that died in just 48 hours.
The immediate aftermath of this spectacularly failed Friday to Sunday campaign was a strict regulatory timeout. Because they formally withdrew their proposal under UK takeover rules, Kraft Heinz was hit with an immediate 6-month ban on making another move for Unilever. They were completely locked out. They had shown their hand, they revealed their appetite for a mega merger, but had absolutely nothing to show for it at the end of the day. They walked away from the table in defeat, but, and this is key, they walked away with their massive financial war chest completely untouched.
And that brings us to the ultimate cliffhanger of this entire corporate drama. 3G Capital and Warren Buffett didn't build their massive empires by just sitting still. They are financial hunters. And they still have up to a $15 billion war chest just burning a hole in their pockets. So as we wrap up this explainer, the lingering mystery in the financial world isn't really about the Unilever deal that failed. The real question, the one that keeps CEOs up at night, is this: who is next on their hit list? Is it Mondelez? Is it Danone? Maybe Colgate-Palmolive? Only time will tell when the next Friday afternoon leak will shake the financial markets. Thanks for tuning in, and stay curious.